All right. I like to take this opportunity and discuss question number 10 on chapter 3 homework. Okay. And again, please attempt this question on your own first before you watch the video. All right. And it's a good idea for you to have the question on the side. All right. So 10 years ago, Reem and Forsan took out a $150,000 mortgage to buy their new house. Okay, the mortgage was a 20-year, 10% mortgage with annual payments. All right, today the bank offered similar mortgages at 8% interest. However, when the young couple went to the bank to ask about the possibility of refinancing, all right, with a 10-year, 8% mortgage, they were informed that the bank has a $15,000 quote unquote exit fee for the refinancing. All right, so the question is, should they still refinance the mortgage? All right, so the analysis here is, it's a very simple analysis here. All right, so it's about mortgage refinancing. All right, so our methodology is to compare the cost of old mortgage to the cost of new mortgage in year R. All right, as we know, year R is the ultimate golden standard. All right, so let's look at year R for the old mortgage. Okay, and let's look at year R for the new mortgage. Okay, now for the old mortgage, that's 10% mortgage rate, and that's APR. And it does not say whether there's any other cost or fees. So we just take that to be the 10% APR. All right, and if you want to find out, the EAR, I can probably do effect function here. It's 10% APR, and they are paying annually, so that's 10% EAR. All right. So now the question is, what is the EAR for the new mortgage? Okay. So we need to think about, all right, the refinancing. All right. So refinance is basically you borrow at the 8%. All right. Now that's a lower rate. You borrow enough to pay off the older mortgage. Okay, so that you're left with only one mortgage. That is the new mortgage you're paying annually to pay off the new mortgage. All right, so pay annually to pay off the new mortgage. All right, so the question here is we need to analyze or need to focus on the cash flows from the new mortgage. Okay, so I'm going to build a timeline here, right? And zero, and this is, and by the way, the old mortgage was actually done 10 years ago, and now 10 years passed. So if they're going to do a new mortgage, it's going to be a 10-year new mortgage. Okay, so I'm going to build a 10-period timeline here. All right, and now I have to look at cash flow per period. Okay, from the new mortgage. All right, so I have to think about what is the cash flow for the new mortgage, under each period. All right, so the first question is, what is the cash inflow? All right, so let me call this part A. All right, so part A, what is the cash inflow, or how much is the loan they're going to borrow? All right, so to find out part A, how much they need to borrow, okay? So we need to consider two things, all right? If they're going to pay off the old mortgage, first of all, how much they owe on the old mortgage. All right, and secondly, don't forget there's an exit fee of $15,000, okay? So, what they need to borrow is going to be the summation of these two things, all right? So first of all, how much, do they owe on the old mortgage? Okay. All right. So if I want to, analyze the old mortgage, all right. So I'm going to do another timeline here actually I have this here, so I'm just going to copy and paste here. All right, cash flow, per period from the old mortgage. Okay, so we know that it took out $150,000. All right, and every year they're going to pay off this old mortgage. So I'm just going to look at the annual payment. So I'm going to do a payment function here. So the rate is 10%, and this is for 10 years. Excuse me. This is for a 20-year mortgage. Okay, so they're going to have 20 years to pay off. If they pay annually, and present value is the loan, 150,000. Okay, future value is 0. So if that's the case, then that is how much they need to pay every year. All right, so they have paid 10 years. Okay, all right, so now, we just need to, the numbers are actually a little messed up. So let me just clean up that. All right, so these are the annual payments per year. And now we're saying how much do they owe, at the end of year 10. All right, so to find this, find the balance. All right, so find the remaining balance in year 10, okay, in the older mortgage. All right, so I'm going to analyze the cash flow from the old mortgage a little bit. All right, you see that this is really annuity, okay, in the sense that this is the present value. These are the constant cash flow, and we're looking for the future value, yes? So I can go ahead and calculate the future value of this annuity here. All right, so the rate is going to be 10%. We're still talking about the old mortgage, okay? And it's for 10 years, and the payment is this number here, and the present value is 150,000. Okay, so if I do that, I get 108,260.78. All right, so that is how much they owe in in 10 years. All right, so they owe. All right, so I'm just going to, I should say how much they owe in the auto mortgage. All right, so that is going to be equal to, all right, so I have the future value, result here, and I'm just going to, flip the sign and make it positive. So they need to borrow a total of how much? As we're saying, they have the amount they owe on the old mortgage, and they also need to borrow the $15,000 extra fee if they're going to actually, do the refinancing. All right, so that's the amount they borrow, and if refinancing. All right, so they only get, they only get this amount here. Okay, so that is 108,260.78 because the $15,000 is deducted by the new mortgage lender. All right, so now we know this part A is going to be the amount they're going to owe. So that is this number here. All right, so now I'm going to look at how much they're going to pay in the new mortgage. So I'm going to do a payment function here. The new mortgage rate is 8%, and they also have 10 years to pay off. And now the present value is the amount they're going to borrow. So that's 123,260.78. Okay, and the future value is 0. Right. So if you do that, that is how much they're going to pay, every year for the new mortgage. Okay, and if I want to be able to copy across, I just need to lock down the B20. All right, so now I can actually copy this across, and I just calculate the cash flow per period for the new mortgage. All right, so now I can actually go about my conventional steps here. I'm going to look at IRR. So this is calculating the IRR, which is actually the annual rate in this case. All right, so that is showing up as 11%. Okay, and if you show the decimal, and that's 10.98. All right, so now I can actually get the APR and EAR for the new mortgage. Okay, all right, so this is going to be equal to the IRR times 1 here because we're dealing with annual compounding. All right, so EAR is equal to effect of the APR and 1 here again. All right, so let me brush these two cells. All right, so now that the decision here is very straightforward. Okay. All right, so if you're going to compare the EAR of these two mortgages, all right, so this is the EAR for the new mortgage, all right, and I'm going to compare this to the EAR for the old mortgage, okay, all right, so EAR, if the EAR for the new mortgage is greater than the EAR for the old mortgage, then we're going to say do not refinance, all right, so if this is true, if the EAR for the new mortgage is greater, which actually is is true in this case, all right. If otherwise, then the the EAR for the new mortgage is lower, then yes, you're going to go with refinancing. All right. So in this case, the decision is do not refinance. All right. So you see that we're still focusing on the cash flows from both mortgages. All right, and based on the information we have, we can actually calculate essentially, the EAR for the new mortgage and compare that to the EAR for the old mortgage. Okay, I'll stop the video here. I hope this is useful.